Good evening, everybody. Thanks very much for joining us again. This week, I want to take a look at how we can use technical analysis to help us initiate trades, stay with trades in times of big events, big market-moving, high volatility events, and look at a particular indicator that we can apply when we're in this type of market, and one that helps us and gives us confidence to run positions because we're continuing to see signals to maintain the ongoing trend in a high volatility environment. And that is where obviously the greatest potential profit is actually in place. So yeah, why can technical analysis help us in times of increasing volatility? Well, one of the basic tenets of technical analysis is that price discounts everything. So everything that's known by the market, be it an interest rate decision, non-farm payroll, whatever, is then discounted by the market's reaction. So everything that's known, all new pieces of information are reflected within the perception of value of the asset that we're looking at. And as that asset demand or supply increases because of the new information, then prices will move in that direction of the initial break. But does this mean if everything that we need to know is within price, does this mean that we should ignore a fundamental approach or fundamental analysis? Well, no. At Corellian, we believe that a combination of both fundamental and technical approaches are very important. We need to know coming into a big event such as FOMC what the market is expecting and what the expectations, whether they be met or not, and the likely market reaction to that announcement before it actually comes out. Because basically, does the data point, does this new information meet those expectations of the market? If yes, then the market may not react. Everything may well be discounted in price, and we won't actually see a significant move materializing. But if positions have been squared, so in other words, people have had positions coming into the big event, and they've closed their longs or shorts ahead of that event because basically they're unsure as to how the market is going to react, those initial positions, once that new piece of information has come out as expected, may well want to be reestablished. So we could reestablish and continue the original trend after a short-term blip within price activity. Now, if those expectations weren't met, and it was a surprise data point or a surprise move in rates or lack of move in rates, then we may well see increased volatility as prices discount the new information that the market has just received. Because as we know, price discounts everything, every new piece of information and every new event. Okay, so let's take a look at how technical analysis may have helped us on May the 3rd, the last FOMC meeting. And we're going to take a look at dollar yen on a 30-minute basis from the 1st of May up to just before the FOMC announcement. And we're looking at Bollinger Bands because, as you may have heard me mention before, I believe Bollinger Bands are probably one of the most reliable indicators within technical analysis, not only for establishing the trend, but also by reflecting increasing volatility. But more importantly, when that volatility is likely to see an acceleration phase in the direction of the ongoing trend. So by using the Bollinger Band, we look at the mid-average, which gives us the directional trend. If the mid-average is falling, we're in a downtrend. If it's rising, we're in an uptrend. And the bands, which are two standard deviations either side of the moving average, reflect the increasing volatility within price activity. So as volatility increases, the bands will widen to reflect the chances of price action following within this downtrend move, following the lower band and accelerating, seeing increasing volatility within this ongoing downtrend. Okay, so let's take a look at the run up to the FOMC announcement on May the 3rd, and what was actually happening before this announcement. Well, looking at dollar yen, there was a number of reasons that perhaps we might have wanted to be short from a technical viewpoint coming into the FOMC decision. We had, as we've said, the Bollinger Mid-Average falling to reflect a downtrend. We'd seen prices break below that mid-average. We'd seen acceleration. The bands begin to widen as we see continuation of that trend, and we're tagging the lower band. And within that situation, as the bands continue to widen, that volatility can increase and continue the directional market move. Well, as the market consolidated into the 3rd of May, we saw a test of the declining Bollinger Mid-Average. And this can act as a very important and strong resistance focus within that ongoing downtrend. So in other words, we can look for the mid-average to act as a resistance point, a potential failure point of a consolidation to resume the ongoing downtrend. So coming into the FOMC announcement, we were seeing bearish dollar yen positions, negative trends, increasing volatility in certain points, and even when the volatility wasn't increasing, we were seeing a declining mid-average and parallel Bollinger Bands, which reflect a downtrend, not with aggressive volatility, but with the risk of resistance being found at the mid-average and support being found at the lower band. So we're trading within a downtrend channel, if you like. So evidenced from a technical viewpoint was justifying holding short positions in dollar yen just coming into the FOMC announcement. Okay, so we then get to 5:30 p.m., 6 p.m., about an hour ahead of the FOMC announcement. If we'd been lucky enough to be short, then we'd be holding a profit on the trade. Now, with it being such a big event, there is always that uncertainty involved within price activity, especially having seen an aggressive decline already. So we may well be tempted, because we don't know what's going to happen with the FOMC, to close short positions, take the profit, move back to the sidelines, and see what happens within price activity, and to see if we then generate new signals. So we'd seen acceleration to the downside, having failed at the mid-average once more, and an hour or so before the FOMC announcement, I think I'd be tempted to move back to the sidelines. Well, as it turned out, within the next hour, we weren't the only ones perhaps that we were looking to reduce risk and take some profit on short positions, and the market rallied back well just into the announcement. So in other words, what we were looking at was, yes, we'd seen a bounce, but the high probability of this upside move being based more on short covering, squaring up of positions into this big announcement, and really no change from a technical viewpoint in terms of the 30-minute chart. Yes, we'd broken above the declining Bollinger Mid-Average, but we would anticipate some sort of rally coming into such a big event as the FOMC represented in May. Okay, so we then saw the announcement come out. And at 7 p.m., it was an increase of 25 basis points, which was pretty much within market expectations. And if we'd listened to strategic views and fundamental views, like, for instance, Mo's comment at the time was that it wasn't a particularly great surprise. We'd seen the expected 25 basis points. And the takeaway, having seen that increase, is that a pause is possible. No word of a cut within the statement, but with the caveat on data feeds, as the Fed is now clearly data dependent. So the takeaway from this and the announcement was that there was no great change in the situation. Risks were that we could perhaps see a pause in higher rates. The market had had its expected rise, and that may well see further selling pressure developing to re-establish the ongoing downtrend. And when we look at the reaction in terms of technical analysis, the sell-off following the announcement saw a break and close back under the declining mid-average. And that is a further negative signal. Because if this was a basing activity, if it's more positive themes, we would expect the mid-average to hold as a support point, turn higher, and even for an uptrend to re-establish itself. But with the fact that we closed back below the declining mid-average, we were seeing re-acceleration of the downside. For me, that was a signal alongside the fundamental view that nothing really had changed within the market, was that dollar yen could see further selling pressure. And we then developed these themes by tagging the lower band, the bands beginning to widen, highlighting increasing volatility. So the risk of the market continuing to trade along this lower band within a more negative stance. We then came to 10:30 p.m. Now we've all got to sleep. So basically there's a decision to be made at this point. Do you want to run the position overnight where pretty much anything could happen? You're uncertain. Yes, you'd have to place a stop. Of course, that is always a need with any position that you have. But we'd seen a decent move. We'd seen the technical signals supporting this acceleration. Again, it might well have been tempting to take profits on this short position, having seen this acceleration to the downside. And basically, just look more for a pause within expectations, and then we can take another look in the morning. Well, if we'd held the position overnight, not a great deal happened. We moved sideways. And it really would have been the next day at about 7 a.m. that we broke back above the declining mid-average, which then started to turn and flatten out. So we would have potentially have been stopped out on the short on that break. So it would have been similar sorts of levels, a little bit higher than perhaps if we'd done it the night before. But the important point here is that we then started to see the flattening in the mid-average, the contraction of Bollinger Bands. So in other words, consolidation, a slackening, a decrease in the volatility in price activity, and the risk of a more extended consolidation, potential for a recovery move. So it's important when we approach these important and significant data points or interest rate decisions that A, we're aware of the expectations of the market and what's likely to happen if those expectations are met or not. And we can use technical tools like Bollinger Bands to monitor how the market's actually trading, how it perceives the reaction to that data, and whether or not we're starting to see acceleration with increasing volatility, which is where we all really need to be active within the market, because that potentially is where the greatest profit can be made within these accelerating periods when, yes, we've got uncertainty, increasing volatility, but by using the technical tools, we're continuing to monitor risk, we're managing our positions and exposure within the market at that time, and we're taking and reacting to any new technical signals that start to develop, a break in the mid-average, flattening out, decreasing volatility, to reduce our risk and just stand aside and see what happens until we start to see new signals being generated, in which case we can then revisit the market and take new positions.